In the year 2035, the world had changed dramatically. The concept of money, as we knew it, had undergone a radical transformation. The physical notes and coins that once filled wallets and piggy banks were now relics of the past, replaced by a new form of currency, virtual money. The shift towards virtual money began in the early 21st century, with the advent of cryptocurrencies like Bitcoin. These digital currencies operated on blockchain technology, a decentralized system that allowed for secure peer-to-peer transactions. However, the volatility of these early cryptocurrencies and their association with illicit activities made them a risky proposition for many. In the 2020s, the world saw the rise of Central Bank Digital Currencies, CBDCs. These were digital forms of fiat money, issued and regulated by the central banks of nations. Unlike cryptocurrencies, CBDCs were stable, as they were backed by the reserves of the central bank. They offered the convenience and security of digital transactions, without the risk of extreme price fluctuations. By 2030, most major economies had launched their own CBDCs. The United States had the digital dollar, the European Union had the digital euro, and China had the digital yuan. These digital currencies coexisted with traditional banking systems, offering an alternative form of payment for goods and services. The transition to virtual money was not without its challenges. Governments had to grapple with issues of privacy and security. There were concerns about the potential for government surveillance, as every transaction could be traced and monitored. To address these concerns, governments implemented strict data protection laws, ensuring that transaction data could only be accessed under specific circumstances. The shift to virtual money also had significant implications for the world economy. With the elimination of physical cash, the cost of minting coins and printing notes was eliminated. This led to significant savings for governments, which could be redirected towards other areas of the economy. The use of CBDCs also facilitated faster and more efficient cross-border transactions. In the past, these transactions were often slow and expensive, involving multiple intermediaries. With CBDCs, transactions could be completed in real time, with minimal fees. This boosted global trade and economic integration, as businesses could easily transact with partners around the world. However, the rise of virtual money also posed challenges for the global financial system. The widespread adoption of CBDCs threatened the dominance of the US dollar as the world's reserve currency. Countries no longer needed to hold large reserves of physical dollars for international trade, as they could use their own digital currencies or other CBDCs. This led to a shift in the global balance of power, with countries like China and the European Union vying for greater influence in the global financial system. The shift to virtual money also had implications for monetary policy. In the past, central banks used tools like interest rates and reserve requirements to influence the economy. With CBDCs, they had a new tool at their disposal: programmable money. This allowed central banks to implement monetary policy directly by programming the digital currency to respond to certain conditions. For example, they could program the digital currency to lose value over time, encouraging people to spend rather than hoard money. Despite these challenges, the benefits of virtual money were undeniable. It offered convenience, security, and efficiency, transforming the way people transacted. It also opened up new opportunities for financial inclusion. In many parts of the world, people lacked access to traditional banking services. With virtual money, all they needed was a smartphone to access a range of financial services, from payments to loans. As the world moved towards a cashless future, there were also concerns about the potential for cybercrime. Hackers and cybercriminals were always looking for ways to exploit the system, and the shift to virtual money presented new opportunities for fraud and theft. To combat this, governments and central banks invested heavily in cybersecurity, developing advanced systems to protect against cyber threats. In conclusion, the future of money is virtual. The shift towards virtual money is transforming the global economy, changing the way we transact, and reshaping the global financial system. While there are challenges to overcome, the potential benefits of virtual money are immense. As we move towards a cashless future, we must ensure that this new form of money is secure, inclusive, and beneficial for all. Subscribe.